Snap-on just dropped Q1 2026, and the tape tells two stories. Revenue came in at 1.207 billion, beating the street by 2.5%, but EPS landed at 469, missing 475.
A penny here, a dime there. Yet shares are sitting at 390, knocking on the door of a fresh 52-week high at 488 cents shy of $400. The market is paying up for something.
Top line beat, bottom line miss, stock near highs, valuation compressed, net cash on the balance sheet. That is a fascinating setup heading into a possible technician channel recovery.
Welcome to Charged Alpha. Today we unpack Snap-on Incorporated, ticker SNA, a $20.3 billion industrial that quietly compounds while nobody talks about it.
Snap-on is one of those businesses most retail investors have never modeled, but every working mechanic in America knows the red toolbox in the bay.
The company sells professional tools, diagnostics, and repair information through 4 segments. Snap-on Tools Group is the biggest, at roughly 40% of revenue, sold through franchisee vans rolling into auto shops every week.
Repair systems and information is 32%. Diagnostics platforms, software, undercar equipment for dealerships and independent shops. Commercial and industrial is another 25%, serving aviation, military, and heavy industry.
Financial services rounds it out at roughly 7%, financing tool purchases for technicians who often cannot get a traditional loan. That captive finance arm is the secret weapon.
The moat here is genuine. Snap-on brand prestige commands 30 to 40% price premiums over Harbor Freight or Milwaukee. Franchisees own personal relationships with technicians, route after route, year after year.
It is one of the last truly local distribution models in industrial America, and it is incredibly hard to replicate. You cannot Amazon a Snap-on van.
So why does this earnings moment matter? 3 things converge. The stock is within striking distance of its all-time high, yet the multiple has actually compressed.
Snap-on trades at 19.8 times trailing earnings. Historically, the stock has lived between 22 and 24 times. That is roughly a 15% valuation discount to its own normal.
Meanwhile, the balance sheet is a fortress, $550 million of net cash, negative 0.2 times net debt to EBITDA, and free cash flow last 12 months hit $1.08 billion.
Add a 15-year dividend growth streak yielding 2.34% at a 46% payout. This is what quality at a reasonable price actually looks like.
Let us talk about the man steering the ship. Nick Pinchuk has been CEO since 2007, 18 years and counting. He is an MIT-trained engineer with a background that spans Carrier and United Technologies before joining Snap-on.
Pinchuk is the architect of the modern Snap-on. He expanded repair systems and information into the diagnostics powerhouse it is today, and he launched the financial services arm that smooths technician purchases.
His capital allocation has been textbook industrial discipline, steady dividend growth, opportunistic buybacks, bolt-on acquisitions in software and diagnostics, and zero appetite for transformative M&A that would dilute the brand.
Margins tell the story. Gross margin has climbed from 50.3% in fiscal 2022 to 51.9% in fiscal 2025 under his watch. Slow, deliberate, durable.
The only real question is succession. 18 years is a long tenure, and the bench beyond Pinchuk has not been spotlighted publicly. We will come back to that in the bear case. Now the numbers. Q1 2026 revenue of $1.207 billion versus consensus $1.177 billion, a 2.5% beat. EPS 469 versus 475 expected, a 1.3% miss.
Trailing 12-month revenue is $5.12 billion, TTM net income $1.023 billion, TTM EPS 1972. This is a roughly 20% net margin business at scale.
Profitability is best in class for the category. Gross margin 51.3%, EBIT margin 27.2%, net margin 20.0%. Those are software-adjacent margins for a tool company.
Cash conversion is just as clean. Operating cash flow $1.15 billion, CapEx only $74 million, free cash flow $1.077 billion, free cash flow margin north of 20%.
Balance sheet, cash $1.753 billion, Total debt $1.203 billion. Net cash $550 million. Total equity stands at $5.96 billion with goodwill of $1.1 billion.
Multiples are reasonable for the quality. PE 19.8, EV to EBITDA 13.5, price to sales 3.97, price to book 3.40. None of those scream cheap, but none scream stretched either.
The recent EPS track is mostly clean. Q2 2025 beat by 3 cents, Q3 beat by 37 cents, Q4 beat by a penny, then Q1 2026 missed by 6 cents. 3 beats and a small miss.
Forward consensus models fiscal 2026 revenue of $4.75 billion and EPS 19.11, then fiscal 2027 at $4.89 billion and 2001 EPS, and fiscal 2028 at $5.07 billion with 2118.
11 analysts cover the name. The split is 5 buys, 4 holds, and 2 sells, so cautiously constructive but not crowded.
The mean price target is $415, implying roughly 6% upside from the current $390.75. Not a barn burner setup on the surface.
But the dispersion is what is interesting. Tigress is at $475 with a buy. Roth Capital pegs $455 buy. Barrington has outperform at $445.
On the cautious side, Baird is neutral at $395, basically the current price, and Bank of America has the only outright underperform at $340.
That $85 gap between the bull and bear targets reflects a real disagreement on whether the technician channel is bottoming or grinding lower from here.
Time for the bull case. 5 points.
1. Channel recovery. The Snap-on Tools Group has been pressured by softer technician spending. As repair backlogs normalize and credit eases, that segment alone has multi-year operating leverage.
2. RS&I tailwinds. Vehicles are getting more complex with EV powertrains, ADAS calibration and software-defined platforms. Diagnostics and information services should grow above GDP for years.
3. Valuation reset. 19.8 times trailing earnings is a 15% discount to Snap-on's own historical multiple range of 22 to 24. Multiple expansion alone could drive double-digit returns.
4. Capital return. 2.34% yield, 15 consecutive years of dividend increases, ongoing buybacks, and a 46% payout ratio that leaves real room to grow.
5. Balance sheet optionality. $550 million in net cash means Pinchuk can buy back stock aggressively into weakness, fund bolt-on M&A and diagnostics, or weather a recession without flinching.
Now the bear case. 5 points.
1. Technician channel weakness could persist. If auto repair volumes stay soft and franchisees lose tool truck momentum, the largest segment compounds slower for longer than Bull's model.
2. Financial services delinquencies. Captive finance is great in good times, but technician credit quality is pro-cyclical. Rising charge-offs would hit both revenue and earnings.
3. Competitive pressure. Milwaukee, DeWalt, and a wave of online tool brands chip away at the price premium. Snap-on must defend that 30 to 40% gap, and that is not free.
4. Succession risk. Pinchuk has been CEO 18 years. When he eventually steps down, the market will reprice uncertainty until the next leader proves they can hold the moat.
5. Tariff and input cost exposure. Snap-on manufactures globally and sells globally. Tariff escalations or steel and aluminum spikes can compress beautiful gross margin in a hurry.
How does Snap-on stack up against peers?
Stanley Black Decker trades at 0.8 times sales, with revenue down 3.2%. A structurally weaker franchise priced like one. Snap-on's 3.97 times sales reflects the quality gap.
Lincoln Electric is at 3.4 times sales with revenue down 1.5%. Kennametal is 1.2 times with revenue down 2.8%. Both are cyclical industrials trading near or below historical means.
The closer comps in quality are Nordson at 4.1 times sales growing 4.2%, and IDEX at 4.9 times sales growing 4.3%. Both command premiums similar to Snap-on.
Bottom line on peers. Snap-on prices like a high-quality compounder, not like the average industrial. The premium versus Stanley or Kennametal is earned through margin and brand, not hype.
Quick read on options and insider activity. Option sentiment is moderately bullish, with implied volatility sitting near 52-week lows and a slight call skew. Traders are not pricing a binary outcome here.
Low IV near highs is interesting. It usually signals complacency or genuine confidence. With Snap-on, given the cash position and dividend track, it leans more toward confidence than complacency.
On insiders, there is no material trading activity to flag. Pinchuk has historically been a modest buyer on dips rather than a heavy seller, which aligns with the long-term capital allocation philosophy.
So no red flags from the insider tape, no panic in the options chain. The signal here is quiet conviction, not euphoria.
Let us land the plane. Snap-on is a high-quality industrial trading at a mild discount to its own history, with net cash, 20% net margins, and a 15-year dividend growth streak.
Bull case, channel recovers, RS&I compounds on vehicle complexity, multiple re-rates back to 22 times. That is a path toward 450 to 475 over 12 to 18 months.
Base case, modest growth in line with consensus, multiple holds near 20 times, total return tracks dividend plus mid-single-digit EPS growth, roughly 410 to 430.
Bear case, technician channel weakens further, financial services credit deteriorates, multiple compresses to 17 times. That is a drawdown toward 325 to 340, right where Bank of America already sits.
That is our look at Snap-on. If you got value from this episode, please follow Charged Alpha wherever you listen, leave a rating, and share it with one investor who appreciates a quiet compounder.
We drop new earnings deep dives every week. Hit the bell on YouTube, subscribe on Spotify and Apple, and send us tickers you want us to break down next.
We will be back soon with another name worth your attention. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street